We're about to enter territory that's probably familiar to most of us, at least in name: the stock market. When we talk about financial markets, commodities may have been the first thing to be traded, but shares or stocks are certainly the sexiest. And it's not because they're the most common. In fact, Forex outpaces their volume by far, but quite simply because there are more movies about them. These are the assets we hear about most in the news. They're the topic of insider trading tales, crashing markets, and romantic novels. In spite of the bad rep, though, shares are actually much more stable than Forex and commodities. True, you may not have total access to the backroom dealings behind IPOs and mergers, or the surprise closure of a company we all thought was profitable, but mostly, shares move more gradually than the more news-sensitive asset classes. As we said in our first lesson, the Romans invented shares. The government would contract public works, like building roads and ports, to companies owned by the public. In modern times, the first publicly traded shares belonged to the British East India Company, which was licensed to trade in the Far East. The Dutch took the idea further and enabled trading shares through the bourse or public pocket, which had already been trading in diamonds. So, to understand what we're talking about, a company may sell an investor a percentage of itself on an exchange's primary market. The shareholder may then receive a percentage of the company's profits. We call these dividends. He may vote at board meetings in the case of common shares, and he can sell those shares on a secondary market. And because voting or common shareholders may be responsible for a company's health, preferred shareholders, those who can't vote, will be paid for their shares before common shareholders in case of a company's liquidation. Now, traditionally, such shares were actually documented through ownership certificates, but online ledgers are gradually replacing these. To evaluate the fair price of a share, you need to examine the company's product sector, its market share, the makeup of the company's management, its corporate environment, and so on. You'll also need to keep an eye out for announcements like board meetings, quarterly earnings, and more. Now, trading shares is expensive. Taxation and fees are high, and you need to trade them through an exchange. And to do that, you have to be licensed, or else you'll require the services of either a stockbroker or investment firm. Unfortunately, what we've seen over the past decade is that middlemen will often act in their interests or those of their employers instead of yours. Luckily, the over-the-counter market for share-based CFDs has been flourishing. As with commodities, you can invest in a share's rising value, but also its declining value. And you aren't limited to shares that are available through your own local exchange, but you're connected through your broker's platform to stock markets around the world. In our next class, we'll talk about the share's indebted cousin, the bond.